Thank you for joining us. Just a quick introduction. I'm Simon, Showman, CEO, Andrew Gossage, Managing Director, and Chris Dent, CFO, for some of you that don't know us. It's been a very interesting year. I'm going to go through some of the highlights. We're very, very proud of the achievements this year with profit and growth. It's been really tough. It's tough out there. Consumer is tough, but we've done a great job in difficult times. Just to run through some of our operational highlights, the relaunch of Petra, which was the German brand that we bought 18 months ago, that has now gone into the German market and has been a success. We've done £3 million worth of turnover in our first year. And now the object and what we're doing is we're now going to roll it out to new retailers. Kaufland is repeating, but there's more retailers we're going to put it into. And we have found very good success online in our EU operation. So Petra is now selling in Spain, in Italy, in France, and in Germany. And we've got some really strong plans for the Petra brand. The renewal of our Russell Hobbs license from a 3-year license is now a 4-year rolling contract. So that now takes Russell Hobbs off the table as any concern. And Russell Hobbs, as we all know, is a fantastic brand. And we use Russell Hobbs as a big door opener in our European expansion. Continued investment in AI and robotics. Andy will go into that in further detail, but it is a real game changer in the business. Our inaugural ESG strategy was launched last year. We have actually been on this for 3 years, and we are industry leaders. The big retailers, Primark and Sainsbury's and Tesco's, come to us for the presentations. We're on scope 1, scope 2, and now we're heading to scope 3. And it's a really important part of the business, and again, makes us different to our other competitors that are out there. Very excited about the new European showroom that has opened in Paris. And this is on a state-of-the-art showroom complex, which I will go a bit further into. On page 7, our investment. Why invest in us? Well, our brands are getting stronger, and this gives us more resilience. Our online and EU operation is growing, and this is where there is so much opportunity. We're still so small in Europe. The opportunity online, as you've seen, the figures for online the last 18 months have been fantastic. And we've definitely been held back in Europe. There's a lot to do. We've been held back on stocks, on retailers being overstocked. And also, the new showroom in Paris has already brought so many more opportunities just in 30 days. We've had great success in Germany, and the team is very strong in Germany, but moving the showroom over to Paris was definitely the right thing to do. If we go to page 8, you can see how the brands have given us resilience and how we've now grown. So FY18, the UP own brands were 52% of turnover, and now they're 79% and growing. License reduced from 24 to 10, and own label reduced from 24 to 11. This makes the business much stronger. We've now taken the new brand director, Tracy Carroll, who joined 12 months ago this week, has made a massive difference to the business. We do feel now we are becoming the A brands, but we're still the focus on price and volume and just being above own label. You know, we want to provide beautiful products for every home, and that is our clear mission. If you go to page 9, you can see here why I'm saying I think, you know, we've definitely been held back in Europe. Overstocked with the retailers in Europe. They are taking longer to deal with it than the UK. We are seeing some glimmer of hope, but we still feel another 6 to 8 months between our big customers clearing their stock levels. And we were definitely held back by our biggest customer at the time, which was Action. Not being able to deal with the Action account because they trade face to face did hinder us. That's now fully back on track, and Action's in growth. So with Action, the French showroom, and the clearing of stocks from the European retailers, Europe is where the big growth is going to come. And if you look at our business model, we're doing £1.72 ahead in the UK, and in Europe at the minute we're only doing 10p. So you can see where we're focused. And if you go on to page 10, I'll hand over to Andy.
Thanks, Simon. So, as Sam mentioned, there were some headwinds in FY23, particularly around retailer overstocks, which in itself was I suppose, an aftershock from the COVID crisis. You know, retailers had bought off the back of quite volatile COVID demands, which often meant that they went into this period sort of early calendar year 22 onwards with too much of the wrong type of stock, particularly things like summer seasonal, but also cookware, which will explain why our cookware numbers were down during FY23. But despite that, we still reported record numbers, both in terms of revenue and profitability, and I suppose once again demonstrated our resilience as a business, because although our supermarket segments and discounter segments went backwards a bit, online leapt forwards sort of 64%. Last year it was different because online was flat because of the shipping crisis and the lack of stock availability, and other segments like supermarkets, for example, made up the difference. So and if you look at the pie chart on the left-hand side of page 10, you'll see that's because of the way we've changed as a business. In FY18, we were majority discounts, and supermarket and online were quite small. Now we have, as you can see in the pie chart at the bottom, we are much more balanced as a business. Back in FY18, if the discount segments had a problem, we had a problem. Now, if individual segments are under challenge, we can kind of move the tanks around the lawn and address that, and that's exactly what we did in FY23. So really pleased with that performance in the face of a very difficult trading environment. We move on to page 11. So we've talked about this in the past, but you know it's often quite difficult to explain. Those of you who've been to sites will understand better, I feel. But our operational model is, we think, truly unique. We've tried to encapsulate it in this graphic on the page here. But it's at its core is our culture of continuous improvement. So retailers make it quite complicated for suppliers, and they make it complicated because that's what makes it simpler for them. I don't blame them, but that can make its scalability quite a challenge. We serve 300 customers a year, over 3,000 SKUs, and we do it to exceptionally high service levels, something which I think we demonstrated during over recent years. So in order to do this, it's about multiple marginal gains. And as I say, that at its core is based on a culture of continuous improvement, which in turn is built on our graduate development scheme, having lots of people in the business, bottom up, suggesting ideas for automation and other improvements. And then what we do is we execute those ideas. That generates increased productivity, in turn higher salaries, and we've recycled probably about 2/3 of our gains into higher salaries, which in turn means we can recruit better quality graduates, and so it goes on. Now, this obviously has very clear OPEX implications, and I'm going to talk a bit more about that when we come to the outlook. But for us, that's just the starting point. The big benefits are some of those other things that you see around the edge of the graphic. So things like, it means we can be more competitive on price because we're a more efficient business than our competition. It means we can achieve better quality customer service, better service to retailers, higher colleague satisfaction, because of course we're taking really basic tasks away from our staff and allowing them to focus on higher value tasks. But at the moment, as Simon mentioned, one of the big opportunities is branding and marketing. And what we want to do is we want to recycle some of those productivity gains into increased spend on branding and marketing without jeopardizing those key mass market price points. We want to be on or just above own label. And through this, Whereas other brands have to generate a higher margin to fund the marketing, we want to do this through efficiency and productivity. On page 12, you can see some of the outputs of this work. One of our key productivity metrics is gross margin per head, as you can see here on page 12. We've increased it over recent years from just above £80,000 per head to nearly £115,000 a head. And what's brilliant about this graph is most of it's been delivered without robotics and AI, which robotics has been the last 18 months, AI less than 12 months, really, in terms of our use of it. So we believe we can continue with this kind of 45-degree chart, a graph, and we can take productivity, gross margin per head to £130,000 per person within the next 2 to 3 years, growing this metric by, say, sort of 5% a year. I'm going to hand over to Chris now to talk through the numbers on page 13.
Thanks, Andy. So revenue up in the period 8% to 166 million, which is a record for us. That is driven purely by mix and volume and not by price. So we want to be a price point which is just above own label. So, we want to very keenly price our product, which we're very proud of doing in the current year when you have a cost of living crisis. That doesn't mean that we don't have the ability to increase price overall. It's just we do it by a different methodology than year-on-year prices. So if you think of a £24.99 kettle, a £24.99 kettle will generally always be a £24.99 kettle. If the costing of that in some way changes, what you end up doing is introducing a new replacement product. And that is what we do year on year. So we will sell around 3,000 products in any given year, and we'll introduce between 600 and 1,000 new products each year, which allows us to reset the price and reset the gross margin. So the driver behind the revenue in the year has really been that 64% increase in our online sales. In the previous year, as Andy mentioned, that was held back because of the shipping crisis, which meant that we weren't able to import as much as we wanted to. So we concentrated on supplying our retail customers rather than our own online channels. Talking about our retail customers, in the current year, that was very much so a game of two halves. In the first half of the year, we found that the majority of our retail customers were overstocked at that point in time. As we entered the second half of the year, we saw some reversal of that, and we saw growth returning to that segment. That does not mean that the overstock problems have fully dissipated. It means that we have started to see them easing. In that, it's probably true to say that our discounter customers have been a lot better at clearing their stock than our supermarket customers. And it's also true to say that in the UK, they've been better than they are in Europe. So that continues to be a bit of a headwind for us as we go into FY24. But at some point, that will turn into a tailwind as those overstocks are fully cleared. Going down the P&L onto our gross margin. So our gross margin is up quite strongly in the year to 25.7. So part of that is due to mix. Online has a slightly higher gross margin than our sales to retailers. But the other big factor of that is about freight rates. So during the shipping crisis, what we saw is that the average freight rate went from $2,500 up to about $18,000. In the autumn last year, that reversed and we saw a collapse down to about the $1,000 that we're currently getting. That benefited our P&L from the start of January and February. So the freight rates dropped in October, but as it works our way through our system, through our stock, and as things arrive in, we got the benefit of that in the second half of the year. It is true to say that that benefit is continuing as we enter into FY24. Whether we'll be able to keep the whole of that, it is a question. because quite often our retail customers in particular can see just as well as we do that the rates have dropped, and they start chipping away at it through competitive process. Obviously, with some of it, we will always be able to keep it. So with our online business where we set the price, then we will be able to keep some of that freight benefit permanently. Moving down to admin expenses, they're up sort of like 10% to 21.5 million. The largest component of our admin expenses is wages, which make up 73% of our admin costs, and those rose by 13% in the year. Obviously, there has been inflation, so we want to do the right thing by our people in a cost of living crisis by giving them pay rises. In addition, as Andy was speaking about, that helps our productivity because it helps us get the best people in there, and the best people within our business help to drive those productivity changes by coming up with ideas that we can solve by using our robotics processes. The other part of the admin expenses is £0.6 million investment in Ambiente. Ambiente is the largest German trade show. We have been unable to go to those trade shows in Germany over the course of COVID. This was the first time that we were back there, and that's really important for going and meeting our German customers. So overall, EBITDA up 8% to 20.2 million. Moving on to slide 14, if we look at the bottom end of the income statement, depreciation amortization up, and that is due to our investment in solar panels, which have been very helpful in offsetting the increase in electricity prices that we saw over the winter. They're probably going to have about a 3.5-year payback period. Finance expense up 34%. So it is up quite significantly, but it has been limited in terms of the increase, first of all, by net debt being lower than in the previous year, but also due to the hedging instruments that we have. So we have a suite of caps and swaps, which have mitigated the underlying increase in the base rate interest rises that we've been seeing over the past year. Now, those hedges come to an end during FY24 and into FY25 to align with when we believe that we'll come down to a zero net debt position. Tax expense up 14% in the period. Obviously, we've seen the increase in the corporate tax rate in the UK from 19 to 25%. In the year, our blended rate was 21%. So moving on to the EPS and dividend. Overall adjusted profit after tax up 4%. There's been no change in the number of shares, so adjusted EPS up 4% as well to 15.4p. We have a dividend policy at the moment of paying out 50% of profit after tax in relation to dividend. We continue to do that this year, so the overall dividend per share for the full year up to 7.38. Moving on to slide 16, onto the balance sheet. So the most significant part of that is the decrease in our net debt. So that's gone from 25.2 million in the year to 15 million, leaving us at a 0.7 times leverage. So that's due to the strong cash generation that we've had during the year, but also due to our strong working capital management. So you can see there, debtors down 7%. That has two elements to it. The first is something in relation to the timing of our trading. So we're very strong in the spring compared to the year before, where actually our strongest month was July, which therefore meant that debtors were quite elevated at the end of 2022. But on average overall, our debtor days are down from around 70 to 60, which shows the concentration that we have had on that working capital balance. Again, stock down slightly. So as we were going through the shipping crisis, we were holding slightly more stock than was ideal for the business. So that's come down slightly, which has meant that actually we've had cash coming out of our working capital, which can be seen on the graph on page 17, which shows how net debt has moved over the period. So you can see starting at the 25 and going to the 15, obviously the 20.2 million of EBITDA, but then we have that cash coming out of working capital, which ended up being 121% operating cash conversion. That is quite high for us. I would normally be expecting that to average 80, 90%. As a wholesaler, we normally have a need to invest in our working capital. So that's probably, a factor for the year. Then you can see how we've used the cash. So in tax paid, interest, investment in PPE, the final payment on deferred consideration, which is in relation to the Salter acquisition. So in the year, we've paid off the last of the deferred consideration, but also we pretty much now paid off the full amount of debt that we took on for the Salter acquisition, which was £20 million. Then obviously, returning money to shareholders in the form of dividends, that's 6.2 million. So overall closing debt, 15 million. I just wanted to move on to page 18, show how we do reduce leverage quite quickly as a business. So you can see 2019 to 2021, we paid off pretty much all of the debt. We geared back up for doing the Salter acquisition, and then you can see how that is dropping quite quickly. So going into FY24, we will start to further reduce our leverage. And in the current environment, that does give us quite a lot of optionality in terms of what the business can do next. So Andy, moving over to you, page 19 for the summary and outlook.
Yeah, so just picking up what Chris was saying there, we are heading towards a debt-free position in the not too distant future. Chris has mentioned optionality there. For us as well, it's really what it's going to do in terms of our competitive positioning, because so many people in our space aren't in a debt-free situation. Some are quite heavily geared. In our space, a lot of our competitors are private. Private companies often have more debt and less equity than listed businesses. So I think we think this is going to mean, we're convinced that this will mean in 12 months' time, in 18 months' time, in 2 years' time, we'll be in a much stronger competitive position than we are now, even if the sort of trading environment, continues to be relatively challenging. Also, just to bring forward what I said earlier on about productivity and OPEX, we do think that salary wage settlements will remain elevated. So even as general inflation comes down, we think wage settlements will remain probably above 5% for the next couple of years. That we think is going to put increased, strain on corporates generally, including in our sector. Through our focus on productivity, we have a solution for that. So again, it is going to lead to our competitive positioning being enhanced relative to other people out there in our space. Okay, that's it from us. Hannah, are there any questions?
You have tried to hold prices rather than add for inflation. What pricing power do you have with the big retailers?
So we often get accused of having no pricing power, which does seem slightly out of step with our remarkably consistent gross and operating margin over recent years. But I do understand why the question is asked, and perhaps the way we operate, our pricing power is different to what people might expect. So what we can't just do is take a product and add 3% next year. So we can't take a $24.99 product and all of a sudden sell it for $25.26 or something, or $26.12 or something like that. There are in the general merchandise space, there are set price points. So we'd be looking at moving that product from $24.99 to $29.99. And if you tried to do that in one step, it would lead to a significant loss of volume. So the way that we manage our gross margin is through innovation and new product developments. So if you bring another product to market which has more features, maybe a design change, then maybe it can hold that 29.99 level. So over time, we refresh our gross margin through new product development. But we also don't want to increase our pricing. And our mission is beautiful products for every home. We want to be in that mass market space. We want to be great value. So we will always do everything we can to hold on to the best price point possible for our product.
Perhaps a follow-on from that then. Has your stance on pricing, do you believe, have a positive or negative effect on your market share?
Well, it must have a positive effect. If we are holding prices while others increase theirs, and there is some evidence of that, then we're convinced that it's delivering higher market share. And I think that, combined with what I said before about our debt levels, about our approach to productivity and its impact on OPEX, will mean that our competitive positioning and market share will improve, as over the next few years.
Okay. The big fall in non-online sales, which you have partly explained by destocking, were there any other reasons? It appears you did really well replacing them with online sale. But was this business as usual, or did you do exceptionally well to mitigate the aforementioned sales decline?
No, we put it almost entirely down to that. I mean, Simon, we didn't lose listings.
I think the big answer to that is we never lost listings. We lost volume, but we've still got the listings. So that's what gives us the confidence going forward.
Okay, thank you. Online, a couple of questions around this. Just for clarity, when you refer to online, do you mean direct to consumer, sales through pure players, sales through online units and multi-channels? Which is it?
So yeah, for us, it means predominantly sales via platforms. So the usual suspects, things like Amazon, eBay, and customer dropship accounts. We do have some DTC via salter.com and via Beldray.com, but it's relatively modest compared to sales via marketplaces and platforms.
Okay, and are you happy to break out what percentage that modest contribution is from your own websites?
Yeah, we're probably looking at 1 to 2% of overall revenue comes from our own websites.
Of overall, not of online.
Yeah,
Yeah, okay. What level of operating profit do you think is attainable for a business of UP's nature?
Is that a percentage or is in absolute terms?
Well, it's a fair question. I'm reading out the investor's question. Maybe we could look at margins, perhaps.
Let's answer both. We've got an EBITDA margin of 12%, and we would like, so it may well be in the future that we have the potential to expand that through things like the productivity, our approach to productivity, but we would prefer to recycle those gains into things which will generate further revenue and revenue growth, like, for example, marketing, like maybe price. We're happy with the level of EBITDA margin that we have at the moment. In terms of the overall level of operating profitability, sky's the limit, really, because our addressable market is enormous. That there are kitchens all over the world that we have to go at in the long run. In the short to medium term, we're targeting the sort of 500 million consumers in UK and Europe. That's our focus in the short to medium term. But in the long term, there's the world to go at.
Mm. Okay, thank you.
In that European section, I think it's that stat that we sell £1.72 to consumers in the UK and 10p. So that's why we're concentrating on Europe, because we believe that we can significantly increase our penetration there.
Thank you. Your chart of gross margin per head improvement over the last 5 years is very interesting. It'd be nice to see this also in real terms. What change do you think that might show?
So adjusted for
to sort of, I
inflation.
guess, to exclude pricing benefits and to show genuine cost efficiency gains.
Yeah, I mean, look, I mean, there's lots of productivity metrics we could use, and internally we do use most of them. You know, we use several other products. So turnover per head would be an alternative measure. Operating margin per head might be another one. This just happens to be the we feel as a management team, and they've all got their strengths and weaknesses as productivity measures. We prefer to use this one because a lot of what we want to do with productivity is about recycling our human resource into higher value tasks, which should in turn generate revenue and gross margin.
Okay, thank you. Can you expand a little on your brand marketing budget? What are the plans? Do you see an increase as a percentage?
Yeah, I mean, those of you who already know us know that we're quite tight, and you know, whatever we do in terms of marketing spends will be very much with a view to value for money, because we don't want to jeopardize those mass market price points that we're at. So it won't be advertising, you know, in the break of Coronation Street, and it'll be it is use of social media and including things like influencers, as well as traditional PR, which can be very cost effective actually. And we have a good capability there. I mean, Tracy's appointment's been has been a really strong one because this has been you know, I think we're probably already well known for our execution in areas like supply chain and product innovation and customer service, and we've demonstrated a lot of those capabilities during the COVID period. I think where there has been certainly room for improvement is around our branding and marketing, and that's what Tracy is really bringing to the table.
Air fryers. Obviously, STAs have contributed by far the most category growth over the period. To what extent do you see this level of growth as sustainable? Do you expect to see falls? And how much of this revenue was from air fryers?
Well, we certainly did exceptionally well on air fryers. You know, it's a great segment to be in. It continues to be a strong segment. I mean, for example, you look at search data on Google, searches for the search for the term air fryer is still at elevated levels compared to sort of the early part of 2022. It's the most searched term on Amazon, for example. So it has been a great area for us to be in and continues to be so. There probably was, to be fair, more froth in autumn winter 22 than is now. You know, so that to some extent is a headwind. As I say, it still continues to be a high performing area for us. But when Martin Lewis featured air fryers in September 22 on his website as a great way to save money, it did go a bit bonkers. So it has normalised. I think the rate of growth in SDA, I mean, when you look at our divisions, it's a bit like customers. They sort of pass the baton between them. From time to time, there'll be years when SDA performs really well, like last year. Cookware went backwards 12% because of stock in the channels. There's other times when those positions switch, and I think, you know, that's what gives us resilience. So we don't think the rate of growth in SDA is a rate of growth we're going to sustain year in, year out for the foreseeable future, and that's not the way it works.
But you do find that we are getting newness, even sort of like within air fryers. So I don't know if you can kind of like bring back up page 7 of the presentation at all. So on page 7, you can see the new air fryer microwave, which will be being for sale in Robert Dias in the current month. So what we're seeing with the air fryer market is, at the beginning, a lot of people buying quite small units. And what is now sort of like driving the demand in air fryers is people moving to larger units. So you're getting replacement already as people move from a single cabinet to a double cabinet. And then we'll start seeing people moving to these dual sort of products. So this is, air fryer, microwave. So one of the things with the original air fryer is that they were less popular in London because people in London have smaller kitchens. They've got less sort of like space on their countertop. So this sort of like newness of product is what it's sort of like going to be the next sort of like round in terms of air fryers. And certainly, the air fryer has entered the public consciousness now. So it's when companies such as M&S on their food labels are now giving the instructions, normal cooking, microwave, air fryer. So it's very different from some of the other fads that we may have seen. So, 2 to 3 years ago, I think you'll all remember sort of like when there were spiralizers, when everyone was making pasta out of courgettes. That was a fad. With the air fryers, it's quite a different sort of like product category where we'll continue to see that being, a good base product for us, which will continue to have that renewal cycle and those sales coming from it.
If we look over to China, question here, how much you see that as the geopolitical problems there interfering with your supply chain and what measures you're taking to mitigate that?
So when we IPO'd in 2017, we had a number of risks in the top right-hand corner. For example, and we've addressed a lot of those. So things like customer concentration, channel concentration, licensing risk, which Simon's mentioned, that we've addressed now. That leaves China. We do very much see China as the biggest risk facing the business, albeit this side of an invasion of Taiwan, probably not one that will affect us, but it remains, we believe, our biggest risk. We do take it very seriously. So, for example, our buying teams, part of their annual bonus is based upon diversifying away from China. But we have in past presentations been very clear on this point. It's going to be a long, drawn out and difficult and slow process given China's position in global supply chains as it relates to sort of consumer goods. So we do take it very seriously, but it's very important that we sort of manage expectations, and it's not going to be overnight.
Okay, thank you. The Salter brand acquisition has been very successful. Do you think there is any likelihood in the future that you'll have an opportunity to purchase the Russell Hobbs brand for the parts that you currently license?
We don't think so. Russell Hobbs is owned by a multi-billion-dollar conglomerate, so we haven't got that sort of firepower yet.
But with that rapidly falling debt.
It's still a few years away. I mean, yes, it would be nice at some point, but we're talking 10, 20, 30 years in the future.
No, understood. Thank you. Do you have insurance cover for unexpected product recalls?
We do not, but we have not had one in the past. And one of the problems with having insurance for product recall is quite often it takes it out of your power, because then the insurers try and sort of like take control of the situation rather than you as management being able to take control of the situation. Obviously, with any insurance, we do sort of like look at it. We do look at the sort of like the pricing each year, but given the great job our sort of like quality control team do, we believe that our liability there is relatively low.
Okay, thanks. Robotics. What are you doing that is so helpful? Have you contracted out any builds?
Yeah, so I mean, first of all, just to make clear, we're not talking about little geezers walking around the warehouse picking stock. This is robotics process automation, so it sits at server level. And again, it can be difficult to kind of get across what we're doing here, because we are talking about multiple relatively small marginal gains, and it's largely around tasks which are, I suppose, administrative in nature, and therefore releasing up resource to focus on higher value tasks. So let me give you a couple of examples to illustrate. So it might we have one retailer where we have to go onto a particular portal to order price labels, and that would take one of our more experienced merchandisers 6 to 7 days, once a quarter. That's now done by the robots, and it takes an hour. And of course, as well as kind of saving the time, which is great from an OpEx point of view, it releases up that high value resource, which we can recycle into things that generate revenue and profit. But also it means things like the error rate is lower, so our retailer gets a better service. And it also means we can get the purchase order to the factory 6 days earlier, which again helps de-risk the supply chain. So there's all kinds of other benefits of doing these things. I mean, just to give the investors on the call a bit of an insight as to just how effective this is. I require a minimum payback period of no more than 8 weeks per project. So Chris mentioned 3.5 years on the solar panels, which we're all delighted with. With the RPA, it's 8 weeks, maximum. Up until about 3 months ago, it was 4 weeks. So I've moved the marker out a bit, but we're talking about effort which is really delivering substantial and indeed immediate returns.
Extremely helpful. I think this question is probably to be directed to our website, and a reminder that you can find forecasts in our note at the Equity Development website. But can you put a value on potential sales into Europe for 2024?
I don't think we've put anything out there at the moment. I would prefer people to go to the research, to be fair.
Yeah, fine. Last question then. The growth of Salter's obviously been extremely successful. To what extent is this down to rebranding similar products, or have you seen weakness elsewhere which has amplified the strength of Salter?
We've not. The rebranding is still going on, and it won't be out in the market for another few months. We are definitely taking more market share with the Salter brand. Our performance over the last 3 years to the bigger retailers has steadied us in very, very good ground, and we are taking more market share in the supermarkets with the Salter brand.
I mean, just the other part of that question, Hannah. What we haven't done is just rebadge a load of Progress, say, as Salter. The two brands sit in slightly different places anyway. But to be fair, when you have a license which has an expiry date, it can be make you feel a bit jittery at times about, to what extent should you invest in that brand, to what extent should you invest in brands that you own. And it has been a big relief to have full ownership of that brand and be able to drive it without those doubts in the back of the mind. I think I can't measure that, I can't sort of quantify that, but I think it's definitely been a factor, I would say.
Brilliant. Well, thank you all for your time this morning, to our listeners for joining us and with such great questions, and we look forward to an update in 6 months' time.
Great.
Thank you
Thanks,
very much.
everyone. Thank you for your time.
Thank you.